New Markets Tax Credits for Affordable Homeownership. If any of you did attend the session last week, this is an identical session just to hit multiple times. So we're not going to have anything different except maybe Q&A than we presented last week. But we're excited that you're all joining us here today. I'm Kristen Bloom, the Director of Lending here at the Housing Assistance Council. And this is our webinar on New Markets Tax Credits for Affordable Homeownership. For those of you who aren't familiar with HAC, with the Housing Assistance Council, we are a national nonprofit organization with a focus on rural, affordable housing and community development. We have a mission of improving housing conditions for the rural poor with an emphasis on the poorest of the poor in the most rural places. We have a special focus on high needs areas and groups like Indian Country, Mississippi Delta, farm workers, border colonias, and Appalachia. But we of course work all across the country as well. We have 4 primary lines of business. We have a research and information arm that does a lot of data analysis and studies on rural housing and rural issues in general, and does a lot of excellent research. You should check out our website. Our research and information arm also just launched a brand new data tool called Rural Data Central, which is something you're all able to sign in and use and get data on your communities. And I encourage you all to check that out. Dan's going to put a link in the chat for those of you who want to try out our new tool. We're excited about that. We have a policy and advocacy arm that works to keep rural communities informed on public policy issues related to affordable housing and serves as a nonpartisan and respected expert on rural issues and affordable housing policy on the Hill. We have a training and technical assistance division that you're probably all familiar with because many of you are probably participants in that program, but if not, it focuses on developing the capacity of local leaders and nonprofit organizations to help their own communities. We do this through formal trainings, one-on-one TA, and connecting organizations to resources to help build capacity and build projects. And then we have a loan fund. That's where I sit here at the Housing Assistance Council. We make loans of a variety of types to support development and preservation of affordable housing in rural communities. HAC has been working since our founding, really, more than 50 years ago, to promote affordable homeownership in rural communities. One significant way we've done this is through a program called SHOP, the Self-Help Homeownership Opportunities Program. This is pass-through funding from HUD. We apply every year and get this funding, and we pass it on through a competitive process to organizations building self-help housing. And with this funding, we provide 90% forgivable loans. Since 1996, we've provided over $120 million in SHOP funding to support more than 10,000 self-help homes, leveraging nearly $1.4 billion in other project investment. It's had a really big impact on rural affordable homeownership over the years. In addition to SHOP, we've provided other financing for affordable homeownership. Over the past 5 years, our loans have supported over 1,100 units of homeownership housing for low-income households, with financing for land acquisition, infrastructure construction, home rehab, purchase rehab, lines of credit, things like that. So we've been doing that for some time. And of course, our training and technical assistance division works with a number of groups working on affordable homeownership projects. They work with groups providing home buying counseling, 502 packaging, developing for-sale homes, helping them think through strategies, best practices, and helping them think through how to advance a project. And we work with groups building their very first home all the way to those who've built thousands of homes, and everyone in between as well. And through this volume of work, we've seen how much harder it's been in the last few years to develop affordable for-sale homes with rising construction costs and high interest rates. The work has gotten harder. And so we've seen a need for new funding sources and subsidy sources to support homeownership. And we've been looking for new models of delivering homeownership at lower costs. This has led us to New Markets Tax Credits. New Markets Tax Credits have been around for some time, and most of you are probably familiar with New Markets as a source for economic development or community facility projects, but it can also be used for homeownership projects. We found a consultant, Smith NMTC, who I'll be turning the presentation over to in a moment, who has a successful model that brings New Markets Tax Credits to homeownership projects. Here at HAC, we'd like to use this model to expand New Markets investment in rural homeownership projects, And we're planning to apply in the next round with Smith's assistance. And so we're here today to tell you more about how New Markets tax credits work for homeownership projects. What are some of the project parameters for this type of investment? What kind of project is it going to work for? And to begin the work of building a pipeline for our application to support that application, so we can secure these funds to support your projects, like we do with SHOP already. So Donna Smith, who you're going to be hearing from next, is the Executive Vice President and co-founder of Smith NMTC. She is a New Markets expert with a focus on affordable homeownership New Markets work. She wrote the first exclusively affordable homeownership focused New Markets application in 2006 and has since then gone on to secure over 420 million in New Markets allocations. So now I'm going to turn over to Donna.
Great. And I think Jeanette now, yep, Jeanette is now running the slides. Great to see everyone and or talk to everyone, I guess. So it's good to meet you all. First, I'd like to introduce my team. So Jessica Horner and Jeanette Reynolds and I together form a team that does advocacy, New Markets tax credit applications for HAC, and all of us also work in some aspect of the compliance side of things, and also on closing transactions as needed as well. And both Jessica and Jeanette work very, very closely on writing applications. And the biggest part of writing these applications really is developing the pipeline for the CDE, and that's for HAC. So we're here to explain everything to you as best we can, and also meet you so you can ask further questions as we develop HAC's pipeline. Jeanette, if you want to, thanks. So just a very brief intro for folks who maybe aren't at all familiar with New Markets tax credits. The program was first enacted in 2000 through the Community Renewal and Tax Relief Act by Congress. It's a federal program. Purpose was to incentivize private sustained investment in low-income distressed communities, done through a tax credit that has a 7-year lifetime from the time of closing to the time of exiting the transaction for good. It's a 7-year compliance period. The CDFI Fund, which is an arm of Treasury, the IRS, has managed the program since its inception in 2000. They've awarded roughly 81 billion in total in federal tax credits to community development entities. It's a competitive application process. Then private investors, usually corporate, larger entities, oftentimes banks or arms of banks to satisfy CRA credit type of requirements, will be the investors in the New Markets tax credits, and then they'll use it against their tax credit. Against their federal income tax requirements. So just a brief history, I guess, just to give you a brief idea of how long we've been doing this and how much in total has been done in homeownership. There's been 81 billion total, as I said, of New Markets invested. Unfortunately, not even 2% of that has been invested in affordable for sale housing. And even today, you will still find CDEs or other folks who say they didn't know that the New Markets tax credits could be used for affordable homeownership projects. But it can be, we know it can be, because since 2008, we have done over $720 million of affordable homeownership transactions, a total of 154 projects. It's actually now over 7,500 or 7,000 homes, 33 states plus the District of Columbia. And we have worked with 24 organizations who apply for and receive the tax credits. They're called community development entities, or CDEs. And Jessica will explain that to you a little bit in more detail in a few moments. So it's not unheard of. It is done. And Habitat for Humanity International has its own CDE. However, back in 2006, when we first developed the concept of using New Markets and a model to use New Markets for homeownership, we, being my husband and I at the time, went to Habitat for Humanity International, along with U.S. Bank Community Development Corporation's New Markets folks. And U.S. Bank, just CDC, happens to be located here in St. Louis, where we're located, and happens to be the largest investor in tax credits in the country, which was fortuitous for us. They were familiar with Habitat for Humanity here in St. Louis and agreed to go with my husband to talk to Habitat for Humanity International and discuss with them, hey, we'll write the application for you. US Bank will be the investor. You'll select your affiliates. Do you want to try it? They said yes. So in 2007, we wrote an application and received funding, or allocation rather. In 2008, we did the first transaction with Habitat for Humanity, 5 GoZone affiliates shortly after Hurricane Katrina wreaked havoc on that area. And since then, as I said, with Habitat, we did 108 million. We then split with them. They continued to do more on their own, and we continued to wrap up the ones that we had worked on together. We've since then have partnered with Housing Partnership Network, Community Housing Capital, which is a NeighborWorks America affiliated lender, and now are excited to be working with HAC, and hope to cross that billion mark within a year or so of funding affordable for sale homes. I just want to give you a brief timeline, but the caveat is that with what is going on in Washington right now, everything is up in the air. I think you all feel that probably more than we do, certainly as much. So these timelines are based on prior years. There could be bumps in the road or changes in the timeline. But if there are changes, it's not going to move anything up faster. It might sooner delay. So this summer, we're going to work with HAC, and we're going to develop its pipeline as we start preparing for the next round of New Markets tax credit applications. Then in the fall of this year, we should hear an announcement from the CDFI Fund for those folks who applied for the 24-25 New Markets tax credit round. They'll hear if they got an award or not. Then later in the fall, usually roughly a month or so after award announcements are made, we'll hear from the CDFI Fund again as to when the New Markets tax credit allocation application for 2026 will be released, and then what the deadline will be for that. The caveat with that is that in 2025, the New Markets tax credit existing legislation expires. And so we need a renewal of that, or an extension act. There are both in the House and the Senate, bills have been introduced to do that. Again, with what's going on in Washington, we can't predict when that would happen. We will then apply for allocation for HAC. Usually the application would be due early, as in sometime in January of 2026, and then the cycle begins again. And then in the fall of 2026 is when award announcements would be made. So the earliest that any project that you would be applying to HAC to have funded would be very late 2026 or early 2027. And with that, I believe I turn it over to Jessica.
Yes, thank you, Donna. Okay, I'm going to walk you through the key terms for the new markets world, because we love our acronyms in this world. So before we really dive into anything else, I just want you to be able to see those and hear those and know what they are as I'm talking about them as I go through. So I will walk through the terms, and then I'll walk through the different entities and how the new market structure works. We will walk through a couple of diagrams that are just explanations, and then we will walk through some that have specific numbers. So as Donna already mentioned, a CDE is a community development entity, which HAC already is. It's the entity that will have or has the tax credit allocation to deploy. A Qualic B, or Qualified Active Low Income Community Business, is the entity that is the NMTC borrower. You have a POB, which is the portion of business, which is a Qualic B entity, and we will talk more about that in a little bit, but that's just a separate accounting entity, not a separate legal entity. Then you have the investment fund, which is created and wholly owned by the tax credit investor. and holds the initial funds to flow down to the Qualic B, well, to the CD, then the Qualic B. You have the leveraged lender, which is an entity that makes a loan into the investment fund for the new markets transaction. You have the QEI, which is the qualified equity investment, which is the investment that the investment fund flows down to the CDE. It's the combination of the leveraged lender or the leveraged loan funds and the tax credit equity that the investor puts in. And then you have a QLICI, which is the qualified low income community investment, which is the new markets funded loan that is goes to the Qualic B. So let's talk a little bit about how this works. As Donna mentioned, the CDFI Fund is the one who administers the new market tax credit program and awards the new market tax credit allocation. They make the determination of the reporting requirements and all of that. So the CDE, or the Community Development Entity, applies to the CDFI Fund to receive an award of allocation, and that is what HAC is in the process of working to build this pipeline to do. Once they receive an award, or if they receive an award, then they will deploy that allocation. In order to do that, they need an investor to provide the capital for the tax credits. Once they deploy the allocation, they deploy it to the Qualic B, and then the CDE also has to do their impact reporting to the CDFI Fund as well. So the Qualic B, for the purposes of home ownership, is typically a nonprofit developer. And a Qualic B will submit a project to a CDE for their pipeline, typically for their application, in order to potentially receive an award from the CDE to fund their project. And then once you receive that award from the CDE, you will receive the QLICI loan at the closing from the CDE. Next slide. So let's talk about the qualified equity investment, or the QEI, which again is the combination of the leverage loan, the funds from the leverage lender, and then the tax credit equity that is input by the tax credit investor. All of that goes into the investment fund, is pulled together, and together that's called the QEI, which then is loaned down to, or is an investment made into the CDE, the Community Development Entity. Next slide. So the leverage lender is an entity that can be the sponsor or parent of the Qualic B, or for the purposes of the homeownership model, it is an entity that is created and owned by the Qualic Bs and the transaction. So in the homeownership model, which we'll see here in a few minutes, and I'll walk through with you, is a multi-Qualic B structure. So you typically have anywhere from 3 to 5 Qualic Bs in a closing. Each one of those would have their ownership percentage in that leverage lender entity, because for the purposes of getting to the closing and receiving an allocation, you are required to come up with about 2/3 of the total allocation amount to bring to the table. That can be in the form of a loan or a line of credit that is often called the source loan. HAC could be a potential source for your source loan, or it can be another CDFI or other banking relationship you have. It can be in the form of grants and donations, any cash you have on hand, or previously incurred costs. And those previously incurred costs, you can recapture up to 24 months from your closing. So these potential projects that you submit for HAC's application would not technically close, or would not be able to close based off of if the tentative, very tentative award announcement timeline that may or may not happen depending on the government situation, would be March of 2027, let's say. So you could go back to March of 2025 to recapture those costs and that could be your leverage to go into the transaction. We can go to the next slide. So once the leverage loan and the tax credit equity go into the investment fund as the QEI, then the QEI goes down to the CDE. Then the CDE makes a QLICI loan, which is represented here, the Qualified Low Income Community Investment, which goes to the Qualic B. The QLICI proceeds can be used for pre-development costs, previously incurred costs, acquisition, construction, hard costs, or developer fees up to 10%. Next slide. So let's talk about what a Qualic B really is. The Qualic B, for the acronym purposes, is the Qualified Active Low Income Community Business. It is the borrower that receives the QLICI loan from the CDE. It is a business that is located in or provides services to low-income communities. It can be a special purpose entity or a portion of business. Again, this is what we talked about earlier. That portion of business is not a separate legal entity. It is just separate books for accounting. You can do it either way. The home ownership model is done in such a way that the portion of business is the better option, just because you don't have to create another entity. You're not so it keeps your expenses down if you just do the separate accounting piece of it for the portion of the business. It can be nonprofit or for-profit. The difference in a nonprofit or for-profit entity is if you are a for-profit entity that participates in these transactions, that tax credit equity piece of it at the exit of the 7-year compliance will be seen as forgiveness of debt that has accounting consequences. So it is something that you would need to get with your accounting team on to determine if it is right for you to pursue in that way. That is why the homeownership model is structured in a way for it to be a nonprofit entity, because that gets the most net benefit to your project, and you don't have those tax implications at the end of the compliance period. And you do have to maintain that Qualic B status through this 7-year compliance. So a new market tax credit transaction does have a 7-year compliance period. Like I said, it is a QLICI loan. It's a loan that's on your books for 7 years, but also to maintain that Qualic B status, you would have to sell one compliance home per year to remain an active business. Go to the next slide. Okay, so this is a simple structure that we're going to walk through here. Simple being that we made all the numbers even in a sense. This is a $15 million new markets transaction allocation. So the community development entity had 15 million in allocation that it needed to deploy. It got 3 nonprofit developers and awarded each of them 5 million in allocation. And it found a tax credit investor to invest at 77 cents. So they received their 39% credit of the and that's the 5.85 million of the 15 over 7 years. That's their tax credit benefit that they receive. And then their equity piece that they put in is the 77 cents that they pay for. So it's the 4.5 million equity goes into the investment fund. So then that leaves 10.4 million approximately for the leverage lender piece. So each of the nonprofit developers, they either got their source loan, or they had cash on hand, or their grants, or they had came up with their piece of the leverage lender, which was 3.4 million. And it can be in combination. It doesn't have to be one of those items. It can be a combination of those items. And then, so they each put the leverage lender and the tax credit investor put their piece into the investment fund, and then the QEI is made to the sub-CDE, and then the 3 QLICI loans are made to the Qualic Bs for approximately 4.8 million each. And those loans are 4.8 million. That's less the fees for the CDE. That's why they're not 5 million there. And then you receive approximately 4.4 million on the day of closing to spend on your hard and soft costs. This includes everything. And the reason that it's 4.4 million and not the 4.8 is because that's less the other transaction closing costs that are associated with new markets. So you'll also see in the left-hand box the net benefit amount of 932,000 approximately. that net benefit is part of that 4.4 million, is part of that total amount that you receive on the day of closing. So the net benefit is the tax credit equity that tax credit investor is putting in, less the transaction and closing cost. And it is the portion at the exit that you do not have to repay. That's where that, if you were a for-profit entity, that forgiveness of debt piece would come into play. But if you're nonprofit, this is the net benefit that you receive on the day of closing to spend however you need to spend it. You want to go to the next slide, Jeanette? So as I just said, the net benefit is the tax credit equity less those costs and expenses of the closing. You receive it at closing. It's your project subsidy, and it does not have to be repaid. Typically, the net benefit is estimated to be around 20 to 25% of whatever the leverage amount is. And you can go to the next slide, Jeanette. It can be spent to scale your production. It can cover market gaps or affordability gaps, or hiring smaller contractors to work on the project as well. Next slide. So once you get to the closing and receive your net benefit and spend your funds, you do have reporting requirements as a Qualic B. So your financial requirements are that you have to sell at least 20% of the homes to buyers earning 80% AMI or below. This parentheses here that says possibly higher in the loan documents just means that you can negotiate that percentage. You can always sell more. The minimum requirement is the 20%. Most nonprofit developers we work with typically do 100% because they're mission driven, and that's their focus, is to try to sell as many homes affordably as they can. But like I said, the minimum is 20%, but you can negotiate any percentage or disclose any percentage that you would like to meet or think that the project will meet or you're targeting. You have to spend your QLICI proceeds in 18 months. So that 4.4 million that you would receive on the day of closing in March of 2027, then you would need to have that spent 18 months from then. And then for the portion of business, for the Qualic B, you would maintain those separate books and records, and you cannot have any employees. You will have monthly first year spend reporting, so that the 4.4 million that goes into that account, we will monitor to ensure that you are spending those funds within the first 18 months, and that's done on a monthly basis. You will reflect the QLICI loan on your books for 7 years. You will reflect that leverage lender loan on your books for 7 years as well. And then you will have the semi-annual loan servicing, which for the QLICI loan, it's a below market interest rate. Typically, you would see below 1% for the rate, and it's interest only for 7 years. And then you will also have the loan payment for that leverage loan service semi-annually as well. And then you have your reporting requirements, which for reports to the CDE, that's called a community benefits report, that is you will execute as part of your closing. And that is something else that will include all of your impact reporting, that as far as your percentage of homes to low income buyers, what other home buyer education and other services you're offering, and things of that nature will go into that community benefits report. And all of that is determined before the closing, and then you sign it at closing, but then you have to report on that annually for the 7 years. You will also have to provide audits and financial statements and tax returns for all the entities, and that just means your portion of business and your portion of the leverage lender entity. And something else to remember as part of this is, even though there is the multi-Qualic B structure, each individual project is siloed. It's its own project. So if something were to happen to one of the other projects, it would not impact your own project. It's just the benefit of combining the Qualic Bs all together keeps those new market tax credit transaction costs low. In a traditional transaction, and if you were to do it as a single Qualic B structure, you're going to have the impact of all the fees from the CDE and the accountants, et cetera. And so that's why it has been structured to do the multi-qualic fee to help keep those costs low, and again, to make sure that the qualic fees receive the most net benefit. And now I will turn it over to, when you talk about what Smith does for qualic fees. So even though there is a lot of compliance and reporting, our team does help to, it helps manage all of that compliance for you. It will help you setting up the books and the entries for those books, working with closely with your accounting team to do that, and for the community benefits report, and helping you stay on track of all of that and facilitating the entire transaction from pre-closing to post-closing and all in between. Smith helps to do that, as well as the help that we give CDEs. And now I will turn it over to Jeanette to talk about the project types.
Thank you, Jessica. And I have Post-it notes everywhere that say talk slowly, but I will try to get through these so that we can have plenty of time for questions. But feel free to put questions in the chat. And if we can type an answer in the meantime, we will. But if not, we'll have some time to go over them. So project types, what types of homeownership projects are compatible with new markets? NMTCs can be used with all types, including everything that's in this list here: new construction, rehabs, single and multifamily, condos, duplexes, ADUs, accessory dwelling units, sometimes referred to as in-law suites, mixed income development, so long as 20% or more of the units are sold affordably to low-income buyers, land trusts or shared equity models, as well as rental property conversions. And an example of that is Atlanta Neighborhood Development Partnership, also known as ANDP, is acquiring single-family homes from large holding rental investors to rehab and sell affordably in multiple neighborhoods across the Atlanta metro region. So that's one example of rental conversions. Are NMTCs right for your project? Number one, is the project located in a qualified census tract or meets targeted populations? And there is a guide that is linked in the reference slides, and you'll also receive these slides as follow-up from HAC, and so you can go over this information again on your own and reach out to us with questions. So for new markets, a census tract is considered qualified as based on median family income and poverty rate. That's a median family income no more than 80% and a poverty rate of at least 20%. If the project is not in a QCT outright, for example, your project is located in a census tract where the AMI is above 80%, so long as the AMI is below 120, there is an opportunity to meet what's called targeted populations to qualify if at least 60% of the proceeds from the project home sales are from affordable sales to low-income buyers being those earning 80% AMI or below. And Jessica, of course, went over this, that you will need to spend the NMTC funds in 18 months. And that's not that the construction of the project needs to be complete in 18 months, but all of the NMTC funds for that project have been spent within 18 months. Number three, will you sell at least 20% of the homes built affordably to buyers earning 80% AMI or below? And this is in response to a question also that came up in the chat. Are the total development costs for your project at least $3.5 million? And this is a recommendation based on our experience. Doing a new markets deal with less than a $4 million allocation may not result in a significant net benefit to justify participating in the process and all of its commitments. And we can help if you have your project costs estimated. We can help estimate the net benefit for a potential NMTC project based on those total project costs and anticipated fees, as well as that pricing. Can you raise the leverage funding that you need by closing? And again, you'll need to have all of those, the leverage sources that Jessica outlined ready at the date of closing. Number 6, can you build and make best efforts to sell 1 home per year in a qualified census tract for the 7-year compliance period? And also be prepared to report on home sale details for compliance. And finally, no residential rental. The homes that you develop, be those condos or townhomes or rehabs, must be for sale. So what makes a strong NMTC project? These are criteria that may make your project more attractive to a community development entity like HAC as a potential project that they would like to provide NMTC allocation to in the form of a QLICI loan. So desirable characteristics, of course, HAC's mission is to serve rural areas. For the NMTC program, we have a mapping tool also linked in the reference slides, and we can put it here in the chat in just a bit as well. And you can use that to confirm your project's location in a non-metro census tract. Higher distress criteria. CDEs commit to deploying 85% of their allocation to projects that qualify as what's called higher distress or severe distress. Higher distress can be met in more than one way, including meeting specific census tract conditions, like an unemployment ratio of at least 1.5 times the national average, or a poverty rate of 30% or higher. Other criteria include location, such as colonious areas or Appalachian Regional Commission defined area. There is a reference slide that has those specific criteria listed out, and also the intake form for an NMTC project for HAC has information on these as well, and we will be sharing that. Project impact is other desirable characteristics, so number of homes, selling homes, what percentage is going to be sold to low-income buyers. So again, what is the project impact? Related to that, strong outcomes and stories. How is a specific project meeting specific neighborhood or community needs? And does the project strategy align with development plans? And finally, underserved state. These are identified by the CDFI Fund, and they're announced when the application is released. For this past round, the underserved states were Arizona, California, Colorado, Connecticut, Florida, Kansas, North Carolina, Texas, Virginia, and West Virginia. So there's usually not a big change to all of those, but there's usually some change in 1 or 2 or a handful. Other considerations include the timeline. Again, it will be important that you will be able to spend QLICI funds within 18 months, and that 24-month look-back period that Jessica mentioned for reimbursable expenses supports this requirement, meeting this requirement. Strong organizational track record is important for, that's your track record for developing home ownership. So building and selling for sale homes. Community outreach, engaging stakeholders as well as residents in a process to gather input on the project and its impacts is important. And smart growth principles is what this final little checkbox describes. Proximity to jobs, services, transportation, if that is relevant to your project. Is your project ready? So there's 2 categories of ready that are referenced here. We are talking to you today so that you will be able to assess whether you have a project that may be ready to be part of the submission of HAC's New Markets allocation pipeline application as part of their project pipeline, which is an important part of the application. And again, we anticipate that to be released in the fall. So what does that mean to be ready to be part of the application project pipeline? You may have the site identified or purchase plans in place. There, if it's a scattered site, you have the areas, the census tracts identified. Your organization has a track record of working in those areas or has relationships. there's sufficient details that are available about the project. So if your project is ready, we will go over your homework on the next slide. And then ready for allocation funding. Again, if we submit the upcoming 2026 round application for HAC in early 2026, then a hypothetical announcement of that award decision would be in the fall of 2026. And so in 2026, early 2027 is when you would be contacted to update your project details, and HAC would be going through a process of evaluating projects in their pipeline to understand which might be a good fit and ready to receive a QLICI loan for their project. So this is the homework part. So the next steps will be, and please feel free to reach out to us with questions that you may have about this program, or if you want us to help run through some numbers to understand if it seems like a worthwhile effort. But there is an intake form that you'll want to submit. And again, reach out to us if you have questions about that. We will begin reviewing projects as soon as they're submitted, really. For this initial review, we would really like to receive projects within the next month. I believe it's May 13th. So within the next month would be desirable for us to get an idea of HAC's pipeline and provide plenty of time for us to reach out if we have any follow-up questions for the information that you've provided. But of course, that deadline is rolling, though, overall, because we do not know when the application will be released. And so leading up to the fall, though, we will be wanting to have a better idea of what that pipeline for HAC would look like of projects, which helps determine what size of an allocation we ask for of new market tax credit allocation. And that's all for me. And again, I think what we've done in the past is you can put questions in the chat, or I think we have enough time if folks felt brave enough to unmute and ask their question that way as well.
Yeah, you're also welcome to turn cameras on if you want to show your face too. But and people can raise their hands if that's an easy way to organize people who want to come off mute. And I think we will be sending out a link to the project intake form, probably to everyone who participated, but I think we can also post that in the chat because and then
yes, and I can
just
do
added
that
the
right
mapping
now.
tool. I didn't know if there's any of these while we wait for questions. I didn't know if any of these questions that have been in the chat we should also address out loud in case they're of interest to more people. Donna, go ahead.
Does the link, is there a link to the mapping tool on our deck? I can't remember.
Yes, in the reference
Okay.
slides. Yes, and I can.
Oh, you already,
so
okay,
that,
and you've already put them in the chat
know,
too. Okay, great.
So this is what you'll receive. You'll receive that hyperlink here, and as well as a guide for more information on qualified census tract requirements.
Perfect. So
can you remind me, does it have to be, you said it has to be in a qualified census tract, or you can meet it with targeted populations? Can you just expand on that a little bit more? So, because I know we have some organizations here that I don't think are in qualified census tracts. Is this still an option for them?
Targeted populations. Is that what you're asking, Kristen?
Yeah. How much more work is that? Is that a viable path for people?
So I'll just answer it real quickly. And I apologize to Jessica because I think we were originally going to have her do the first three questions, but I'm seeing really weird things on my screen where different people are named different people, and I don't see Jessica at all. So Jessica, I will find you soon, I hope. But in the meantime, I'm just going to respond real quickly. So targeted populations means that the area median income of the area can go up to 120% AMI. But in order to meet the entire targeted populations requirement, it can be no higher than 120% AMI. And you have to agree to serve or to sell homes in such a fashion that 60% of your revenue of the total revenue from sale of the homes is going to be from sales to buyers whose incomes are 80% AMI or below. That's basically the requirement. There's
Okay,
a
thank you for.
little more nuance, but I think that's good for now.
Yep. And Jessica
Yep.
can answer the questions if you wanted to do that.
Well, I'm going to let Jessica do the next one if I can find if there is another
I'm on
question.
here.
There you are. Your name's there, but I actually see Eddie on split in two boxes of people. So with your name under it. Sorry. That's why I'm saying there's something going on with my computer. Sorry. But
So
I
here's
don't
a
see another
question.
question. Yeah, go
Yeah,
ahead.
so there is a question. Should we submit a hack project intake form if we are at the beginning stages of planning with our board and staff? I would recommend looking at that intake form. We've just shared a link, and it will provide some guidance as to what information you would want to have ready to submit to the project pipeline. And then I think if anyone else has additional information for that. Does that sound
I
like
think
sufficient
given the
sufficient guidance?
timing, I think early is okay, assuming you have enough information, because these projects won't be able to close until 2027.
Right.
That's right. I would think if you have enough to have a discussion with your board and staff about where it is, and you can see if it qualifies, and you have an idea on the number of homes, and how you're planning to map it out, if that's what you're doing in that meeting and trying to determine all that, you should be able to put that, you could be able to put that in the intake form and submit it.
And if we have more questions, we'll reach out too.
Yeah, that's right.
We're not shy about asking for more information.
And you can always reach out to us too and ask questions if needed.
So there is another question. We actually got this question last week as well. How can projects be ready if they won't close until 2027? So kind of related to that ready to submit question as well.
Yeah.
Well, and that goes into, sometimes it takes a long time for these developments to get off the ground. So it does depend on where you are in the stage of the process, but you can also go back and recapture costs as well. So you could begin the development this year potentially and recapture some of those costs. Obviously, you wouldn't want it to be fully developed and homes all be sold, but depending on what stage you are in the process, because sometimes you have huge developments that you're going to have a couple of different phases for. And so you will have to determine what the timing of your project is, but you can go back and recapture up to 2 years worth of cost. So it doesn't have to be in the earliest stages, but timing is an issue, and determining that is just a matter of, can you recapture enough costs to make it a benefit for you to be able to submit it as a project?
So what is the average size project? We're talking about homeownership projects that have been completed using NMTCs.
I would say average would be around 7 million, but Donna, you might be better to answer that. You've seen more than I have as far as homeownership goes.
I'd say the range generally in homeownership is 5 to 12, and the average is probably 7 to 8, is what I would say. There's another question, which is, if you get more than enough good projects for one bundled application, will you submit a second one? For example, if 3 projects are going to be bundled together, but you have 6 good ones, will you submit 2? So it doesn't work that way. The way these applications work is HAC is going to be applying for whatever amount we recommend based on the pipeline that it receives and its lending track record. And so I'm making up a number. Let's say it applies for 30 million. Then it's going to have a pipeline of at least 60 million, probably 50 to 60 million as a minimum, that we would be having in total. It would highlight 30 million of that and talk about those projects. It would more likely than not receive the full 30 it has requested, and then take what it does receive, go back to you all, get your updated information and go through the selection process and then select, say, if it ended up with 25 million worth of projects that it would then provide the allocation to. If that makes sense. So it's a different kind of thing than like if you're applying to your state for LIHTC where you're the applicant. Here it's HAC as the CDE applying, and then it deploys out those funds to you all as the developers, more like it's acting as the state in a LIHTC type deal.
There's an earlier question that came up. What is the penalty for not developing one home per year to maintain active business status? And do these need to be homeownership units, or does rental housing development count?
And I think I tried to answer that in the chat, but basically,
oh, did it? Okay.
Yeah, if you have to be an active business, that portion of the business, that POB that is the borrower in our model, has to be an active business for the full 7-year compliance period. The way the lawyers and all the powers that be have agreed to as far as what activity looks like for this is the development and best efforts to sell one home per year. It can be a new home and it can be an AC rehab, but it could be one unit in a development that you're doing in a condo. If you do condos, it could be one condo, but it has to be a housing unit, a for sale housing unit. It cannot be rental that you are developing and selling to a low-income buyer. If you acquire a home that doesn't need a whole lot of rehab, but it need, you acquire it, you do a little painting, you turn around, you sell it to your low-income buyer, that's fine. Doesn't have to be located in the same area that your project homes are located in, but it does have to be in a qualified census tract. So the answer is, it's not that there's a penalty, you just have to do it, basically, because it's a compliance requirement. And if you have more specific questions, as I think Jeanette said in her answer, we're happy to answer them. Let's see. If the location of the project doesn't show up on the CDFI mapping tool, does that mean that it would not qualify for new markets? Who wants to take that one?
It's kind of
Go
a
ahead,
tech
Jeanette.
question.
Yeah.
So I would say, and can you see my browser right now? Can you see the intake form?
Yeah.
Or do you see the president? You do. Okay. I will say there is kind of, there does take a little bit of practice to use the mapping tool. So if you put in an address, you'll see it zooms into an area, but it does not provide any information. You do have to click on the map at where it is to get the information. And I will say sometimes, especially if it's a new address, you may need to find the location manually, or you may need to put in the census tract. But you presumably are familiar with the area, and we do this when we geocode as well. We are comparing to a Google map to make sure that the structures and the roads and things like that, the features that are on the maps match, as far as, like, you can see here, the example is, the difference is there's 2 census tracts close by. So you will want to make sure that you are looking at the correct census tract, but you do need to click on the map. And I hope that that solves the problem that you've been experiencing. But if not, then we're happy to help further as well.
And you can also use latitude and longitude, right, to find it, if
I
that's
do
helpful.
believe
Sometimes
so,
that's not
yeah.
helpful.
Yeah,
Or
and
it's more
here,
complicated.
clicking here on this mailbox
Yeah.
is where you can go down to
Census tract. Like if you wanted to do 2020 census tract.
yes.
Yeah.
Yeah.
Is it possible? Yes, you can set up specific organization-specific meetings with us and talk to us about how it would work. Absolutely. That's part of what we do. And one of our favorite parts, because we get to learn more about organizations and their projects. So, and our information is on the PowerPoint. So if it's a new markets related question, you can contact us and we can talk through your project with you. Obviously, if it's a related project, Kristen and Eddie, but are there other questions? I know we're coming up on our time. So just in closing, I would say, again, if it's any kind of new markets question or related to a project you have and whether it would be a fit and so on, you have our information in the PowerPoint. And I know that Hack's going to be sending all the materials out shortly. So contact us and we're happy to walk through things with you. If you come up with other questions you want to ask us, feel free to either email or set up a call or Zoom if that's easier. And we look forward to getting lots and lots of projects for Hack. Kristen, anything you wanted to add?
I don't think so. Any last questions? It seems like not. And if there's something we didn't get to in the chat, as Donna mentioned, feel free to reach out. You can also reach out to Hack, although we're not the technical new markets experts, but feel free to reach out to Eddie Vargo or I or Matthew on the shop team, and we can also chat about your project. But we thank you all for coming today. We're very excited about this opportunity, and we hope that you all are excited as well and complete intake forms with your upcoming projects, so we can start putting together that pipeline.
Yeah.
We can all cross
Great.
our fingers that this program
Yeah.
continues to exist.
That's true. That's true.
All right.
Thanks.
Thanks,
Okay.
everyone.
Bye-bye.
Bye.
Bye.